All right. Good evening, everyone. Good evening or good morning, depending on wherever you are. Welcome to the webinar on market risk and counterparty credit risk in Python. This course has a regulatory focus. So we will be primarily focusing on regulatory capital models in market risk as well as counterparty credit risk in this session. This session will last for about 1 hour, including Q&A and everything, so you can plan your activities accordingly. If you have any questions, feel free to post your questions in the chat. And there will be a dedicated Q&A session after I finish the core agenda of our session today. So there you can ask me any questions related to the course, logistics, timeline, all those kind of things. All right. So before I start, a little bit about me. Some of you already know me. So you can call me Satya. Karan and I are partners in Peaks to Tails. So I have taken 2 courses in Peaks to Tails. One is called Bootcamp in Quant Finance, which is which is close to 300 hours course that focuses on usage of stochastic calculus in derivative valuation, mostly. Other than that, I have covered pretty much everything in that course, counterparty credit risk, Monte Carlo. So you'll find lots and lots of use cases, both in valuation and risk management in that course. It's called Bootcamp in Quant Finance. If you are interested, feel free to reach out to me or Karan sir after the course. And the other course that I've taken is called FDP, which stands for Finance Data Professional. And that course focuses on machine learning algorithms and the use of machine learning algorithms in finance. All right, so that's about the courses that I've taken in Peaks to Tails, and I am an IIT-IIM graduate, also have a FRM charter, and I have more than 10 years of experience in capital markets and risk modeling. Okay, so that's about me. And yeah, I already see some questions coming in the chat box about prerequisites and all these things. I would say please hold on to your questions till the end of the presentation. We will take all of your questions in the Q&A section, if that's okay with you. And yeah, so yeah, this session is about, so this course is about market risk and counterparty credit risk in Python. So first question is, what do we want to get out of this course? Why are you all here today? Feel free to, answer in the chat box. What is the reason why you are here today? I want the session to be as interactive as possible. For all the logistics questions, we can take it after the core agenda. Please respond, guys. Why are we all here today? What do you want to get out of this course? Okay, majorly understand the Python practicality with respect to market risk ACR. That's interesting. Okay. Anyone else? Upskill, risk application, applicability in industry, learn metrics on market risk, upskill. Okay. Practical point of view of job purpose, exactly. Okay, all right. So all of you are here primarily to learn beyond what is taught in your regular academic courses and popular certifications, and to ensure or to be more sort of employable in the current industry environment. So yeah, so primarily we are here to learn more about market risk, counterparty credit risk, and applications in Python, and so that you can land a good job, essentially, right? So that is the sort of core focus of this course. It is a practical course, so I will be focusing on the regulatory capital models that are in place today, and we will go through worked out examples, detailed worked out examples in Python. So at the end of the course, you will be trained sufficiently to be able to create or implement regulatory models in Python. And we talked about jobs, right? So let's start from there. So where do we want to get into after this course is basically to land a good job. So I did a search last night in LinkedIn to see what are the kinds of jobs that are open in market risk space today. So here are some of the jobs that I've highlighted. There were 4,500 results. So that many positions are open in various investment banks and consulting firms. So in market risk, if I want to highlight a few keywords, right? So notice here we have FRTB. Okay. Just want to ensure you guys are able to hear me and see my screen, right? Okay, cool. Yeah, so just highlighting a few pointers here. FRTB, okay. Model validation. All right. I want to all of you to go back and just browse LinkedIn or any Naukri.com and go through these market risk profiles and see what kind of skills they're looking for. All right. All of these jobs that I looked at have a median salary of between 25 lakhs to 50 lakhs, depending on your experience, obviously. So it's a very, very lucrative profession. Okay. I don't have to justify that. You probably have already figured that out. But yeah, I mean, just to get a feel of what kind of job descriptions are there for, these kind of roles, log into LinkedIn and go through these job descriptions to get an understanding of what are the skills they're looking at. Okay. So, and also I looked at Counterparty Risk profile. So again, highlighting some keywords. So we have xVA quant, CVA quant, right? And Counterparty Risk, right? So, so for all these jobs, what are the skills that you need? If we look at the skill matrix, right? So we are doing a backward scheduling. This is our target. We want to get a good job in market risk or counterparty risk. For that, what kind of skills are needed? So if I go to skill requirements, first skill that you need is domain knowledge. Okay. Go through the job descriptions and just try to summarize what all they are looking for. If I want to summarize, there are three main requirements. Number one is domain knowledge. So within market risk, you need all these things. Starting with, your fundamentals about probability, statistics, calculus, linear algebra, those need to be really, really strong for a market risk professional. Then you need to have basic idea about valuation of all asset classes. Now, valuation is a very deep subject. As I mentioned earlier, in BQF, I have covered valuation in depth, all right? There are different types of valuations, but in market risk, we're not focusing on different, valuation theory per se, but you need to know what are the payoffs and basic valuation methodology for the instruments. Now, the third point is the most important aspect of market risk. It's called sensitivity and Greeks, right? So in market risk, primarily, I would say 70% of the core market risk calculation is based around calculation of sensitivities and Greeks. Okay. So that's like the backbone of today's market risk methodology. So we'll talk more about that. And then how to calculate the various market risk metrics. So some of you who have gone through FRM and CFA probably know about value at risk and expected shortfall. But those are the key metrics that are used today to capture market risk. So we will cover all of these in our course. I see some of the logistic questions coming up. Please hold these kind of questions till the end of the presentation. Roughly give me a half an hour. Let me go through the core agenda. Then we'll go through all of your questions systematically. Okay. So, and then there is regulatory capital models. This is the focus of this course. So in market risk, as you know, we have Basel III, and the keyword that I highlighted a while ago, that is FRTB, right? That's the new regulation for market risk. So the focus of this course is to do an in-depth study of the latest market risk regulation, that is FRTB, understand all the capital models, the maths behind them, and implement everything in Python, starting with simple instruments to complicated portfolios. All right. So we'll talk more about that. And there is P&L and backtesting. So we will also come back to this later. And in counterparty credit risk space, you need to know how to create exposure profiles of derivatives at different times. All right. I have a slide on this. We'll talk more about this. And CVA, remember we saw this word in the one of the job descriptions, right? CVA stands for credit value adjustment. Okay, so that's also a quantitative metric that we need to calculate. A lot of jobs are there in CVA, in market space. I don't have to, justify again and again. You feel free to go to LinkedIn or any other job website and just look at the jobs that are open in market risk and counterparty credit risk. These are hot areas today. And there is good reason for that. This latest regulation that came, right, FRTB, banks have to be compliant. Originally, it was planned that all the banks have to be compliant by January 1st, 2023. But they have not. Okay, they are still lagging. So banks are pushing because it's a radical change. I will show you what was the previous methodology and what's the new methodology and what are the changes. But this is the new standard. So everybody has to comply with it. And that's why you see a lot of job openings in this space. Banks are trying to frantically hire people who can understand the latest market risk methodology, that is FRTB, and help them implement the new models. Okay. So that's why you see a lot of jobs. All right. So this is the core skill set that you will find common across all these profiles that I just highlighted. Domain knowledge is number one. Okay. Next, technical skills. In today's world, you have to know coding. If you are in a quant profile, or if you want to be in a quant profile, when I say quant, it means valuation or risk management, or even analyst role. Okay. You have to have some background of coding. And of course, if you want to learn machine learning, obviously you have to know coding, right? Earlier days, it was difficult. We had C++, C, Java. They provide a lot of flexibility, but today, everybody is doing Python. Okay. This course is about building regulatory capital models using Python. Okay, why Python? We can talk about this in detail when we start the live classes. But let me tell you this. So if I want to, let's say, calculate value at risk in C++, I'll have to write probably, 10 lines of code. In Python, or 10 or more, it could be 20. In Python, I can calculate the value at risk of a call option on real data in 5 lines. Okay. Because today there are that many packages available in Python and it's free, open source. So Python has a rich community and there are plenty of libraries already available for you to just import them, run them, and that gives you the results. You don't have to write everything from scratch again and again. So that's why Python has become immensely popular today. Especially Python has taken off like a rocket just because of machine learning primarily. But just because, there are lots and lots of packages available today, you just have to plug and play. It's like a Lego block game, right? You just fit the Legos and you get the product, right? So that's why Python has become popular. And it's from a cost structure standpoint, banks are moving to Python. Earlier, banks used MATLAB or SAS. But today they are trying to go to Python because code base is easier, smaller, and from a cost structure standpoint, it is less costly. If you can, so long story short, right? If you can demonstrate that you know about market risk and counterparty credit risk, that's the first part. and you can confidently say that I know how to build algorithms in Python, you'll get any job that you want. There is nothing that will stop you today. This skill, this combination is rare. There are people who are expert and subject matter expert in domain, but they don't know anything about coding. Right? And typical developers that we have, I'm talking about India, so I'm based out of US. Here the things are a little bit different. But developers who are very good in Python or any other coding language do not get the domain knowledge. So you need to master both of these to be a complete quant professional. So that's the need of the hour today, and that's what this course is all about. All right. Okay. And in the job description, you'll find sometimes they mention specific tools that you must have experience in, Calypso or Murex, or there is a product from Moody's called as Risk Authority. So these are commercial off-the-shelf products that banks use. Okay. These are like ready-made risk solutions. So only when you get into a job and, get the opportunity to work on such a tool, you'll learn about the tool. There is no way that you can learn it, I would say, unless you take a specific certification in these to know about the tools. And okay, so the third skill is interpersonal skills. So that's HR, right? So good communication, stakeholder management, client interfacing skills, and then documentation. Documentation is underrated. Okay, in a banking environment, documentation is extremely important. Okay, so these are the three, I would say, there are three dimensions in which you can factor the skills that are required to excel in today's job world today. Now, if you look at different types of profiles that are asked, okay, which kind of profile needs what kind of skill? That's the next question. So let's see. The first profile is quant developer. So if you want to get into model development, okay, that's a hot area here in US. Okay, and they get a they get really good salary. So for that, your domain knowledge and coding skills have to be at the expert level. All right. And interpersonal skills really don't matter that much. If you are looking for a model development role, yes, you have to talk to different stakeholders, understand the requirement, but you really don't need excellent communication skills to be part of model development. This is all relative. Okay, let's look at the next profile. Model validation. Okay. That is another kind of profile you see. So in model validation, what we do is basically there are checks and balances, right? When somebody creates a model, develops model, before it gets shipped into live environment, there are various checks. You have to check various assumptions. So for example, is the time series stationary or not? If there is a normal distribution assumption, it is really valid or not, okay? So model validation is about all, there is a checklist. You have to go through all of these checks and balances and certify, yes, the model has the level of mathematical integrity to be used, okay, in live environment. It's before the new model is shipped, and also there is periodic validation, right? Your assumptions could be valid today, it could be invalid tomorrow, right? So that's model validation rule, validation profile. And for that, you obviously, again, you need domain knowledge. Domain knowledge is always required, okay? And also sometimes you need to, understand the code and be able to debug the code. So definitely you need some coding skills there. Doesn't have to be at the developer level, but definitely you need to understand the Python code and be able to help debug the code, okay? And find out potential issues. And you need definitely some interpersonal skills as well. And there is a third type of profile, which is like a business analyst or consultant. Okay. Now, in consulting organizations like EY or KPMG, you'll find these kind of profiles, analyst. There are analyst profiles in banks as well, but what kind of skills you need to perform well as an analyst? Again, domain knowledge, this cannot be compromised. Okay, you have to be subject matter expert. Technical skills, you probably don't need that much to be a good analyst. But the story is different in US. Okay, even if you're an analyst, you still need your IT skills still needs to be at the expert level. But in India, not so much. Okay. And then you also have to so this becomes important, right? Stakeholder management, client interfacing skills. So it's all about, meeting with different stakeholders, understanding the requirements, translating those requirements into actual deliverables, and seeing the end-to-end development. So basically provide oversight overall, okay, from end-to-end. So that's what the role is. Okay, so yeah, so depending on where, so the skill matrix gives you an idea of where you want to go, okay? But irrespective of the role, domain knowledge and coding are mandatory skills in today's world, okay? The third skill, obviously, that's up to you, that's who you are. We are not training that. So what is this course all about? This course is about these three aspects. You will be trained on the subject, okay, so that you can answer all the questions in the interview. We will train you specifically, how to ace market risk, counterparty credit risk interview questions. As I mentioned earlier, right, the focus of this course is not exactly to go through all the theories and derive everything from scratch. I have done that before in my previous two courses. Focus of this course is more applicative. So we will understand the maths as much as it's needed, but focus will be more in terms of implementation. How can we build a model from scratch with all the checks and balances, data preparation, and building a model and doing sanity check in Python. Okay, so that's the focus of this course. So we will focus on market risk, counterparty credit risk, capital models, and implementing everything in Python. We are not doing C++, we are doing in Python. Okay, I'll just pause here for you to grasp everything I said. Any questions on this? Feel free to post your questions in the chat at the moment. I'll turn on audio after the in the Q&A session. Okay. So yes, we will cover development as well as validation. I'll show you the syllabus slide. There we'll go through all the contents of the course. So let's proceed. I know these questions, so I have answers to all these questions in the upcoming slides. Let's go quickly. So our mission. So my mission of this particular course is to train you to build subject matter expertise in regulatory capital models, okay, around market risk and counterparty credit risk, so that you are able to develop and validate risk models independently. That is important. My job is to ensure that you get enough mathematical maturity and subject knowledge about regulatory capital models. So given a chance, you can independently build algorithms to implement a particular risk model. Okay. Now, to be a real developer, you need to also, you need to have some exposure as an architect. Okay. So there are a lot of many other things that comes in development. But as far as developing an algorithm in Python is concerned to implement a particular risk model, you should be able to do that independently. That's my job. Okay. All right. So let's proceed. So I don't want to, bore you with all the technical details in this particular webinar, because this is not the forum to talk about the various aspects. But I'll just quickly scan through the background and what are the things that are there and what we'll be learning in this course. All right. So what is market risk and what is market risk capital charge? Market risk is the risk of losses that can potentially come from movement in market prices. Okay. You have a trading portfolio. It has stocks, bonds, options, all kinds of things. Now, the value of those instruments depend on market prices, also called as risk factors, right? So what are the risk factors? The risk factors are commodity prices, equity prices. So let's say you have a call option stock on stock, the underlier is your equity price. If the equity price moves, the value of the call option changes, right? Similarly, interest rates. What kind of instruments will be sensitive to interest rates? What kind of instruments will be sensitive to interest rates? Bonds, exactly. Bonds, interest rate swaps, interest rate futures, right? There is also credit spread, okay? So here is the thing. So look at a bond, okay? Value of the bond depends on interest rate. Also, there is credit spread of the issuer. The underlying interest rate, let's say it's the Fed funds rate, okay? Which is the base rate. That could be same, but the credit spread of the issuer might change. So because of change in credit worthiness of the issuer, there is impact on the value of the bond. So that we also capture. So that credit spread is also a risk factor, okay? And then we have foreign exchange. So if you have a FX portfolio, if the FX rate changes, your value changes. So market risk is all about assessing or measuring the loss in your portfolio that can arise because of movement in market factors like these ones. And in Basel, we know this is the governing equation, right? The total capital the bank has to keep in buffer has to be at least 8% of the risk-weighted assets. Okay, the total capital, as in equity capital, tier 1, tier 2 capital must be adequate, and it should be at least 8% of your risk-weighted assets. The more risk you take, your assets become risky. Accordingly, you have to keep more capital so that this ratio is maintained. This is called the capital adequacy ratio. All right. So this is the minimum capital requirements. This much capital you need to keep to do business. Otherwise, you cannot do business. All right. So if you look at the formula carefully, so if you have already calculated the RWAs, which stands for risk-weighted assets, then accordingly, how much capital you need to keep, you can calculate from this. But sometimes we don't calculate RWA, we directly calculate the capital charge. So for example, if you look at just the market risk part, right? So the capital that is needed to cover market risk related losses, that divided by RWA market must be greater than 8%. All right. So market risk capital charge is given as, if you want to calculate RWA market, that is 1/8% market risk capital charge. So in this equation, the first equation, right, that's the main equation of Basel III regulatory capital adequacy ratio. RWA market is calculated as 12.5. This is just 1/8% times market risk capital charge. So we first estimate the market risk capital charge, and then we calculate the RWA by multiplying it 12.5. And then that goes into this equation in the denominator. Okay, you'll find this as the standard way of, either if you can calculate RWA, that's good. If you don't calculate RWA, but instead you calculate the capital charge, then you have to multiply 12.5 to convert into RWA. So in market risk world, what we estimate is this. market risk capital charge. Okay. So yeah, that's what market risk capital charge. So I hope you understood, right? What is the requirement of keeping enough capital? Because if you take, create risky assets, obviously your assets can lose value. And if your total asset falls below your liability, then you go bankrupt. Simple. So you need to have enough capital. And the extent of capital depends on how risky your asset is. And if we isolate this equation just for market risk, this is what it comes down to. So we have to estimate market risk capital charge. Now, how to estimate market risk capital charge? I'll just give you an overview. So you have those who have studied in FRM, right? Already would have gone through this process, but they don't tell you systematically how the whole thing works. So I've tried to paint a very simple picture that will tell you exactly how market risk capital charge is calculated. And we will come back to this, this particular scheme again and again, okay? Because this, the broad scheme of things of how to calculate market risk capital charge is important. So you have to be comfortable with this particular framework that I'll just show you. Before that, when I said market risk capital charge, what we are trying to calculate is you have a trading portfolio. On a given day, how much you can lose, right? That's the potential market risk loss. And against that, I will keep capital to absorb that loss. Straightforward. All right. And when you estimate the loss, it has to be a very conservative estimate. It's not like expected loss. It will be a worst possible loss or unexpected loss. And we typically do that with the help of some confidence interval. We'll learn all about all of these in detail when we work on the actual model. So don't worry about that. I'm just giving an overview. So here is the thing. So we talked about risk factors, right? So in the bank, imagine there is a complicated portfolio. How many instruments are there in a bank? Lots and lots of instruments, right? And all those instruments are tied to lots and lots of risk factors. So let's say there are n risk factors, okay? R1, R2, Rn. Now, the instruments that bank has, so let's say there are two instruments, V1 and V2. The value of the first instrument depends on the risk factor R1. Value of the second instrument depends on two risk factors R1, R2. Okay, that's the second step. Now, at this point, what we want to do is something called as risk factor mapping. That means which instrument is sensitive to which risk factor. That's called risk factor mapping. So here you can see the first instrument is a function of R1. Second instrument is a function of both these two risk factors, right? Portfolio value, your total value of the trading portfolio, is simply the sum of the values of the instruments. So this is straightforward, V1 plus V2. Now, this is what you have today. All right. What will happen tomorrow? Risk factors will change. Instrument values will change. Portfolio value will change. What I want to capture in market risk is what is my worst possible loss in trading in my entire portfolio. And accordingly, I will keep sufficient equity capital to absorb that loss. That's the grand scheme of things. But now, how do we calculate this? As I said, right? Risk factors change will drive the change in instrument values, and change in instrument values will drive the change in portfolio value. So now it's an exercise of how to roll up the changes from risk factors to instruments to portfolio. Correct? So first step would be to estimate the worst change in risk factor. So there is a stock. Tomorrow, what will be the worst possible fall in that stock price? Right? Depends on your position, whether you have a long position, short position. Accordingly, the direction of change that you would be interested in would be different. But ultimately, I want to measure the worst possible change in the risk factor. How do we estimate this? there are three methods primarily. One is historical. I'll just go back in history, okay? And I'll see how much this factor, this particular delta R1 can be. So I will sort the changes in, let's say, ascending order. And then I'll take the worst possible, let's say the worst 5% value of the first risk factor. That's my estimate of the worst possible change. Simply looking at historical data. All right. Second way would be to fit a distribution. That is called as parametric. I will assume, okay, risk factor follows normal distribution. If you have a normal distribution, all you need is mu and sigma, and then you have the entire loss, the entire distribution specified is called parametric. And from the distribution, you can estimate a worst possible change, right? Nu minus sigma z. I don't want to, stress on mathematical details in this slide, but these are some of the ways that you can do it. And the third possible way you can estimate the change is simulation, Monte Carlo. Typically, you'll do Monte Carlo when there is the instrument has path dependency. Okay, so it's not straightforward to approximate changes in a linear fashion or that easily. There are heavy path dependencies, so then you need to do Monte Carlo. Okay, all of this we will do in Python. But the purpose of this slide is this is the big picture. And I want to give you the maturity and flexibility so that you can seamlessly calculate different risk measures using any of the three methods very, very easily and naturally. You don't have to remember any formula. It will come naturally to you. This is all there is. Okay, it's all. I mean, it's all the methodologies and different things are built around this particular idea. So we got the worst change in risk factors. Now we roll up these changes to the instrument level. Okay, delta R1 will trigger a change in V1, that is delta V1. Similarly, delta R1, delta R2 together will lead to change in V2, delta V2. How do we estimate this change, right, from risk factor to instrument value? There are two methods. One is called local valuation, that is through sensitivities. Now, this is the backbone of today's market risk methodology. Everything is through sensitivities. Our major focus in module 1 would be to understand sensitivities, as easily as possible. So sensitivities is king in market risk. All right, everybody takes this route. This is the popular route because this is less expensive. Okay, so when I say sensitivity, think of beta in CAPM, think of Greeks in option. Those are all sensitivities. All right, and there is also full valuation. So full valuation, one example would be when you are using Monte Carlo, you have to use full valuation. And you will use full valuation when the instruments are like exotic, they have path dependency, time dependency. So there you'll use full valuation. Once you estimate the change in value of the instruments, the final step is to aggregate those changes to the portfolio level. All right. That's it. That's how you calculate market risk capital charge. I excluded all the quirky mathematical details, but this is what we will be doing primarily in module 1 to be, to move seamlessly between step 1 to step 2 to step 3, given any instrument or any combination of instruments, given risk factor, use all these three different methods and calculate the market risk capital charge in Python. Okay. And believe me, this is like, once you are thorough with this, the FRTB methodology that we have today is exactly this. It follows this particular route. Two-step aggregation using sensitivities. That's the FRTB methodology. It's just an aggregation process. But by the time we look at regulatory models, you would already be doing it yourself. Okay, the formulas would come very naturally to you. You don't have to remember anything. It will be natural. Okay, so that's all about market risk capital charge. Moving on, we'll come back to this slide if needed later on. So here's a brief history of market risk capital charge. I took this from BCBS website. So they came up with minimum capital charge requirement for markets back in 1996, which was very coarse. Okay, it was not very risk sensitive, and then it went through a series of different evolutions. And they had Basel 2.5 in 2009. There was a subsequent amendment because there were a lot of fallacies in this. It is just after crisis, right? They resulted, okay, the methodology that we have provided in the standard is not risk sensitive. So there was an amendment. And then this is the period where the project of FRTB began. FRTB stands for Fundamental Review of the Trading Book. And if you remember, we saw this FRTB in one of the job descriptions. This is today's requirement in market risk is FRTB, Python, only these two things. Okay, FRTB plus Python. If you know this, you'll get any job you want. This combination is a rare skill, all right? And that's what the focus of this course is. So FRTB project started here, and then a couple of consultation paper came up. And then in 2006, they came up with the revised standard. Okay. And then subsequently, they found that it is still not, there are some technical issues. We'll go look at that when we go through the regulatory models. And finally, they have frozen this standard in 2019. They are calling it as revised standard. And this is effective from 2023, 1st Jan. Are banks ready to adopt this yet? No, everybody is in transitional phase. So when we talk about Basel models, right, whether you look at credit risk or market risk or operational risk or CVA, we'll talk about CVA a little bit. There are primarily two different methods they give. One is standardized approach, which is not sophisticated, but it suits. So if banks do not have adequate tools or processes to model the things internally, they will fall back on standardized approach. And the other approach they have is advanced approach. So big banks who have data and people and process to manage those models, internal models, they will resort to internal models. Okay. So at least today, all banks have a way of calculating market risk capital charge using FRTB, using at least the standardized approach that has already started. Okay. So that's why you see a lot of these jobs in FRTB space today. Okay. FRTB methodology quickly. I don't want to do a deep dive here because this will be the focus of the course going forward. But just to give you a high level, this is the umbrella. So we have standardized approach, and then we have internal model approach, which is the advanced approach. Okay, so inside of internal model approach, we have three different items. One is measure the core market risk capital charge using expected shortfall methodology. I think probably most of you already know value at risk. Don't worry, if you don't know, we'll do it from scratch. But value at risk was the preferred methodology for more than 20 years. And then they finally came up with expected shortfall. So if you look at if you compare the standards, right? Earlier we had 10-day 99% value at risk measured as the capital charge. But now we move to 97.5% expected shortfall. And it's not a blanket 10-day for every instrument. Why for every instrument we should have 10 days liquidity horizon? No, not all instruments are liquid, right? Some instruments will be liquid, some instruments will be illiquid. For instruments which are illiquid, I need to hold bigger capital. Because if things go wrong, I need to liquidate that particular security. If it is illiquid, By the time I'm able to square my position, already, I will incur a big loss because of the bid-ask spread. So they proposed use 97.5% expected shortfall, but for different asset classes, use a different liquidity horizon. Do not use 10-day blanket, 10-day for every instrument. Okay, we'll talk more about this and we'll see detailed calculations of how this is done. Then is something called as non-modelable risk factors. This is the trickiest area that is troubling all the banks today. It's not very straightforward. So what it means is, when you model something, where do you start? Where do you start? You start from historical prices. You look at historical data first, right? And then you build a model on top of it. So there is a question, are we going to cover modeling non-modelable risk factors in Python? Yes. Everything that you see will be doing in Python. If we are not, I'm not covering something, I'll call it out. Otherwise, this is the disclaimer. All of these will be in Python. Okay, so as I mentioned, right, when you want to model something, you need to have a historical time series data for any risk factor. Now, there could be risk factors which do not have data. When we say data as in price data. Basel calls it as real price. Real price means what? You can only trust the price if you have conducted a transaction with that price, or that particular price is quoted in an exchange somewhere. If there is no reliable information of the price, then there is simply no data. Okay, there are some risk factors for which there is no data, and we call those as non-modelable. Okay, so technical definition would be factors which do not have real price history. There are a lot of technicalities. We'll go through this in our course. But if you have non-modelable risk factors, right, then we do a stress test, and based on that stress test, we calculate the capital charge. It's not the regular expected shortfall route. It's a different route through which we capitalize non-modelable risk factors. And then the last one is default risk charge. You would think, why default risk is coming in market risk? Isn't it part of the credit risk? Ideally, yes. But in trading book, so what is the difference between trading book and banking book? In banking book, the banks typically hold those instruments for which the intent is to keep it till maturity. The intent is to receive interest and principal like your loans and hold it till maturity. That's when you put an instrument in the banking book. In trading book, your goal is not to hold things till maturity. Your goal is to do speculation, short-term profits, day-to-day trading. Okay, so that's your trading book. So market risk applies to trading book. All right, because your trading portfolio is sensitive to market price movements. Although there are, FX and commodity risk in banking book also need to be capitalized under market risk. That's one exception. We'll talk about all these nuances later on. But question is, why we're capturing default risk in market risk? The answer is, when you have instruments like bonds in trading book, it is still possible that the issuer can default in the trading book. Okay, so to capture the JT, so JTD stands for jump to default risk in your trading book. So there are instruments which are issued by entities, and that is subject to default risk. It's not like a loan or anything, it's a bond, but issuer may default. So you have to capture that risk as well. Okay, so that comes under market risk. Okay, so that's internal models approach or advanced approach. All right. And there is a standardized approach. So in standardized approach, we have sensitivity-based charge. This is the king of market risk. As I keep mentioning again and again, it's all about sensitivity, sensitivity, sensitivity. So within sensitivity-based capital charge, you remember this slide, this particular path, this, then this, and this. This is exactly what the sensitivity-based approach is all about. So we calculate delta, vega, and curvature risks. Let's not dwell on these topics in the interest of time. And there is default risk charge, which is common, right? And there is a residual risk add-on. Okay. So what is residual risk add-on? So basically, when you do a risk mapping, you map it with systematic risk, general risks, like if your portfolio is sensitive to, let's say, USD to INR rate, okay, that rate would affect many of the instruments for an Indian bank. So that is a systematic risk. Okay. So broad risk factors in market, okay, changes in those will affect changes in your instrument value. That's the systematic risk. But other than that, whatever is left, which are very much issuer specific, or you can call it idiosyncratic risk. For that also we need to calculate capital. So anything that is not captured in the prime risk factors or broad risk factors is part of the residual risk add-ons. We have separate calculation for that. Okay, so all of these we will learn in this course. For every instrument, when I say every instrument, we'll take basically the common instruments for each of the asset class, like interest rate, FX, equity, commodity, and we'll calculate all of this capital charge, both under IMA and standardized approach. And then the next step would be to take portfolios, bond portfolio, option portfolio, stock portfolio, and then be able to calculate all of this for them. Everything in Python. Okay. So that's what will be the focus of this course. Now, very quickly, I'll try to wrap up everything in another 10 minutes, not more than that. This is all about market risk. Okay. So this is what we'll be covering in our course. When we talk about counterparty credit risk, I wanted to present the broad ideas of counterparty credit risk in one slide. So not to do a deep dive here, but yeah. So as much as possible, I just try to give an overview of the different types of risks that are present in a derivative transaction. When we talk about counterparty credit risk, it means it's a derivative trade. You have a counterparty, right? Let's say you are long, then your counterparty is short. Then what are the different types of risks that you need to capitalize? Okay, let's say we entered into a derivative transaction. A and B entered into a derivative trade. This is different from credit risk because the exposure is bilateral. Why? Because when in lending, what happens? Bank will always have exposure to the obligor. It is the obligor who has to pay back, right? So there is a question from Ronak. Is it OTC derivative? So answer is yes, OTC derivatives, and also there are exchange traded derivatives for which also there is a capital charge. Although you would think, can CCP, central counterparty, default? Idea is no, but still there is a 2% risk weight that you have to use as risk weight to capitalize your exposures with central counterparty. So basically all exchange traded derivatives. That also undergoes capitalization. We will talk about it in detail in the course. Okay, so yeah, the bilateral exposure. So as I said, right, in credit risk, it is mostly lending risk. Your exposure is in one direction, unilateral, from bank. So bank has exposure, not the obligor. But in derivative transaction, the value can swing both ways, right? Sometimes value from the perspective of A could be positive. Sometimes it could be positive for B. So the exposure is bilateral. Now, let's say so this derivative was initiated. After some time t, small t, the value of the derivative for A is VA t, okay? It is somewhere here, let's say. So it is positive. Now, what is the value of the derivative? It is VA, right? But today, we actually capture the fair value of derivative, VS star, call it VS star, which is the mark-to-market value of the derivative from the perspective of A with a credit value adjustment, CVA. CVA stands for credit value adjustment. Why do we do this? Is because when we value any derivative, think of Black-Scholes option value. We do not take counterparty's default probability in that valuation, right? So to calculate fair value of the derivative, we need to do some adjustment because to account for the potential default of the counterparty. So this is called credit value adjustment. There are, okay, so it started with CVA, but there are lots of VAs today. If you see literature today, banks are calculating FVA, KVA, colVA, MVA, all, yeah, exactly. All of these are very nuanced topics, okay? There are very different methodologies for calculating xVA, but for this course, we'll only focus on CVA. The reason being, this is the only thing that is capitalized today. We are not capitalizing DVA, FVA on those things. Okay, so the purpose of this course is regulatory capital models. We will focus on CVA calculation and the capital charge that is associated with CVA. All right, but I have covered everything in the bootcamp in quant finance. So if you are interested to enroll in that course, feel free to contact us after this one. Yeah, okay, so this is the value of the derivative, right? Fair value of the derivative. Now, looking at this equation, what are the different types of risks that you can think of that we need to capitalize? A risk is essentially the potential loss that can happen, okay? First and foremost, the value of the derivative itself, that will be subject to the movement in market prices. Simple example, call option, value of the call option will change if the underlier changes. That means if the stock price changes, the value of the derivative will change. So that part is captured under market risk. This is the part that we just talked about, right? We'll take sensitivities of the derivative. For example, let's say Black-Scholes delta, and then use that to calculate the change in value of the derivative. That is capitalized. This part is capitalized under market risk, simply because this part is vulnerable to market price movements, which is in this case is the underlier. Okay. The second part of the risk is the issue, the counterparty can default. Counterparty can default as in he will not pay back the money. If he owes us, he will not pay back the money. Now, we don't know when the counterparty will default. In credit risk, we typically take 1 year PD, right? Here, we don't know when the counterparty will default. So there is a concept called MPOR, margin period of risk. Okay, so there is calculation of that. It basically, MPOR is, it tells you from today, if the counterparty defaults in future, based on your margin agreements, how soon you will be able to discover that default event and be able to replace all your existing trades with the, based on the current market prices in the market. That entire period is called MPOR. In this entire period, you remain vulnerable. Okay, so there is calculation behind this. We'll look at that. So basically, your future exposure at the time of default, right, or at the end of MPOR could be anything. Okay, future value of the derivative. So today it is VA, but at capital T, it could be anything. So primarily what we do in this space is we'll do a Monte Carlo simulation to find out the exposure profile of the derivative at a future time point. All right, that's the first step. And from there, we calculate a host of important statistics: expected exposure, potential future exposure, effective expected positive exposure. Okay, don't get overwhelmed. I know there are it's a lot of technical stuff here, but I'm just giving a broad picture. This slide will be helpful for you to go back and assimilate the big picture. What is happening actually, right? So the simple fact is we captured the market risks, the change in the value of the potential change in the value of the derivative through market risk capital charge, right? And the other aspect is the default of the counterparty, correct? So for that, we don't know when the counterparty will default. So we estimate something called MPOR, that's the margin period of risk. At that time, there could be a range of possible values of your exposure. From this profile, we will calculate. So this is sort of like an average exposure, but we only take the positive values and then take the average. And this is like a value at risk kind of calculation, but it's on the positive side. And this is a bit complicated. Let's not focus on it. So we'll calculate all these, and then these values will serve for two different types of risk. So let's talk about it. First one is this CVA, right? CVA is what? Credit value adjustment. Now, this CVA can change. Because when I recorded CVA, that was based on the credit spread of the counterparty B, right? Credit value adjustment is based on the credit spread of B. Now, in future, credit spread of B can change. So my CVA will change, all right? And remember, in market risk, we capture credit spread risk, correct? So this part, the variability in CVA part is also part of market risk. And for that, the inputs would be expected exposure, credit spread of B, these two go into CVA calculation. And because of the variability in CVA, because potentially the credit spread of B can change, we capitalize change in CVA under CVA capital charge. There is separate calculation for capitalizing CVA. Okay. There is one more risk. And that risk is the actual default of the counterparty. Here, I only captured the potential deterioration in credit worthiness, which is the change in credit spread. What about the actual default? That's part of the credit risk. Okay. If the counterparty defaults, whatever exposure you have, you lose that much money, right? So for that, there is another sequence of calculations. So we have potential future exposure combined with margin and collateral information of the trade that rolls up to exposure at default calculation. And you know that exposure at default calculation is the key ingredient, one of the key ingredients in credit risk calculation, right? Now, exposure in case of lending risk is easy to calculate. Typically, you have a loan, you know how much is the exposure. Sometimes you have to have the amortization schedule, but the exposure is very easily modelable in credit risk. When it comes to derivatives, exposure is stochastic. We don't know. Exposure can swing both ways. It could be positive, it could be negative. So at the time of default, what would be the exposure? That's tricky to model. So we use Monte Carlo simulation. So PFE, margin, collateral information go to EAD calculation. Within EAD, there are two methods. One is SACCR, which is standardized approach for counterparty credit risk. And the other is IMM, which is internal models method. As I mentioned, it's the standard theme in Basel calculations. We always have a standardized approach and we always have an advanced approach. So the EAD calculation, right, for counterparty credit risk, for that we have two separate approaches. And once you calculate EAD, that goes into your the EAD enters into the credit risk capital charge equation, which is the risk of counterparty default. So to summarize, I mean, probably this is overwhelming, but I really wanted to give you this picture. This picture is missing. Trust me, you will not have this picture anywhere unless you have studied Basel guidelines and spent significant amount of time in counterparty credit risk. So just to summarize, variability in value of the trade, market risk, right? Simply underlier changes, value of the derivative can change, how much I can lose, market risk. Credit value adjustment, that is based on the credit worthiness of the counterparty, the adjustment that I do every single time, that can potentially change because the credit worthiness deteriorated or the credit spread of my counterparty changed. That is capitalized under a separate set of calculations called CVA capital charge. And the third is the actual default of the counterparty, which is part of the credit risk. EAD calculation is tricky. For that, we have two methods: SSCCR, IMM. And then this part is the regular credit risk. So whether you are using standardized approach or IRB, based on that, you will calculate PD, LGD, and multiply with EADs, and you are done. So what we will cover in this course? In this course, we will cover so I have that slide here. So let's come here. We will cover exposure modeling because that's the key ingredient. You need to be able to quantify exposure at any future point in time of a derivative. So for FRA, we have exposure profiles, EE, PFE, plot, you can see. All of these have been done in Excel, but everything we'll do in Python. Okay. This is the exposure profile of interest rate swap. So we'll learn how to do exposure modeling. And then we will also learn how to calculate capital charge for CVA using both these methods, standardized approach and advanced method. And EAD calculation, this is part of the credit risk, right? Using SSCCR, standardized approach for counterparty credit risk, and internal models method. So we'll take sample instruments, calculate exposures, and calculate key statistics of each of the instruments, EE, PFE, effective, expected, positive exposure, all those things, and then calculate CVA capital charge and EAD, which will be potentially used in credit risk capital charge calculation. Okay, I know it's a lot of details, but yeah. All right, so learning roadmap very quickly goes like this. In the first module, we'll go through Python basics. So I'll take live classes on Python. These are some of the important libraries, NumPy, Pandas, and Matplotlib that we'll spend some time on. And next would be, really the name of the chapter would be y equal to f of x. That's the name of the chapter. The reason being, in market risk, this y equal to f of x thinking is crucial. When I say y, it is the value of the instrument. When I say x, it is the risk factor. Okay. How do we translate or roll up changes from x to y? Once you master this particular chapter, right, all these formulas that you see in FRTB will come naturally to you. You can write those formulas without even referring to the text. Okay, it's not rocket science. So the focus will be on sensitivity calculation, option Greeks. Taylor series expansion will be the king. Okay, I do have primer videos on this, so that will be shared. And yeah, then we'll learn how to calculate value at risk and expected shortfall for simple instruments using the three different methods: historical, parametric, Monte Carlo. Once we are thorough with this part, in the next module, we'll look at, so this will be done for single instruments. Then we'll look at how we can do all this calculation for a portfolio. Okay. So portfolio mapping, systematic specific VAR, there is factor models and principal component analysis. Lots of banks calculate principal components, and then they use that to calculate systematic value at risk. So we'll look at that. And then we'll take sample portfolios. There is a bond portfolio, different types of instruments, how to calculate value at risk and expected shortfall using these three different methods for a portfolio: stock portfolio, option portfolio. And then once we are thorough with this, the third module will be entire regulatory focus. So we'll take the regulatory text. There are 136 pages. Okay, 136 pages of FRTB document. We will go paragraph by paragraph. I'll show you the calculation, and we will implement everything for a sample portfolio in Python. Okay, so standardized approach, advanced approach. Then there is also something called as P&L attribution and backtesting. So this is like a reality check. Okay. Backtesting means, okay, you calculated value at risk, but how good is that model? Let's say you calculated value at risk for 95%. That means on any given day, your loss, the chances of the loss exceeding value at risk should not be more than 5%. If it is more than 5%, then your model is wrong. That's part of backtesting. P&L attribution is profit and loss attribution. So basically, the risk factors that you have considered for market risk, are they adequate to describe the daily P&L of the instruments? Or are you missing something? Okay, so that's P&L attribution. So this is also part of the regulatory text. We'll look at that. And then we'll go through some of the model validation checks and balances. So what are the common checks that we do in model validation? We'll also review SR 11.7, which is guidelines on model risk. And then there are some case studies from the past that we'll look at. So there is a question, do we cover stress testing? Yes, we'll cover stress testing as well. And there was an earlier question related to quant finance, volatility modeling. Okay, so we'll talk about that probably after this one, because it's a little different. Okay, so, and in the final module, it will be focused on CCR. Exposure modeling, as I mentioned, right? All of these exposure statistics that we'll calculate for different types of instruments in Python. Then EAD modeling, SSCCR, IMM, CVA calculation, and CVA capital charge in Python. All right, so that's the overall syllabus. This is not cast in stone, okay? This is still a little flexible, but what I'm saying is at a minimum, we'll cover this. And we might add some, more content to this depending on relevance. And there will be interview questions, mock interview questions, practice assignments, so that you get a complete end-to-end understanding, and you can ace the interviews. All right, so that's the goal, right? All right, so I'll open the floor for Q&A. Sorry, it took a little longer. All right, let me stop recording. Thank you, everyone.